Welcome back to the Loan Lads podcast. Today we're talking about bridge loans. And no, it's definitely not a loan to buy a bridge, but if you're in Brooklyn, we should definitely chat.
Don't forget to like and subscribe. Check out our website, parkplacefinance.com. And as a reminder, Park Place is a nationwide hard money lender.
All right, Connor, so now we've established a bridge loan is not to buy a bridge. Can you give us a breakdown of what a bridge loan is and what it can be used for?
Yeah, so a bridge loan is a short-term loan designed to technically bridge the gap, which would be between two financing situations, right? So maybe you are, sell a property, or maybe are looking to kind of seize some of the capital, before selling it, or maybe even refinancing into permanent. So kind of want to touch on normal common uses for a bridge loan. What do you typically see investors using this for?
For sure, yeah. So the first one that a lot of people use a bridge loan for is really just to buy a investment rental property. Now, typically you would use a DSCR loan to do that. However, there is some cases where speed is paramount.
Yep.
And to actually get that property under contract and closed on within a short time frame of the contract dates, a bridge loan can be perfect to utilize to actually get that property closed and in your name on title. And then you're going to bridge, basically you're bridging the gap between purchasing the property and getting into long-term financing.
Yeah, and I think another one to touch on for bridging the gap is, let's say an investor has a property. Maybe they've got a bunch of equity in and they're working on a permanent refinancing solution, but they have another deal on the table that they're trying to purchase and they need to seize that capital. Yep. So we'll see a lot of investors come in and maybe take advantage of this bridge loan to obtain a quick cash out to pull some equity to go purchase the next one, while the other one is waiting to be permanently exited.
For sure. So that's a good point. Bridge loans can be for purchases and refinances. Yep. The difference between bridge loans and a fix and flip loan is there is no rehab included in the loan. It is strictly a bridge to purchase or a bridge to refinance.
One common use we want to touch on, which is kind of the most popular in the industry currently, is for builders or developers who have maybe built a recent ground-up construction build, whether it's multiple townhouses, maybe it's even just one single-family custom build or spec. They want to go capture that equity. Mm-hmm. So let's say it's a builder who's building, a couple a month, maybe 1-2 a month, and they need to take advantage of the equity in the property. Mm-hmm. They might go and pull, a quick cash out loan with the bridge loan to use those funds for the next project, maybe get the permits pulled and the plans done on the new build that they're about to start working on, or maybe it's to go acquire the land for the next build. So I think that's one that we see more often than not, especially in today's market with ground-up construction being so popular.
For sure. And kind of to talk about how Park Place Finance go about financing those deals, we actually really like those deals because these are experienced investors, or maybe a new investor that's just built the ground up construction. The client is already showing us that they're looking to perform their exit strategy, i.e. have that property on the market once the build has been completed. There we go, we're bridging the gap, right, between finishing the project and selling the project. And how we look at those, we can actually go up to 70% of the new appraised value of the property. So now that it's been built, of what the current value is. And typically, if builders have built correctly, they'll be able to pull out a decent amount of equity from that property in the form of cash out, along with us covering closing costs and maybe rolling in some payments in reserves there. So like you said, the builder can then go on to their new project, either buy land or do whatever they may be doing with that equity that they've been able to capitalize on.
Yeah, I think the best kind of situations we've seen is these builders who have a ton of equity. Maybe they built it at like a 55, 65 ARV. There's a lot of skin in the game, so they can not only pull equity out, but they can also build in typically anywhere from 6 to 12 months of interest reserves. For those of you watching, what that means is they will build in an interest reserve, which is basically the monthly payments, into an escrow account. Therefore, they have no monthly payments, right? So, for example, if this loan is a 6-month term and it's really just to bridge it between the time that this property sells and it's already on the market, they won't even have to worry about any payments because we've already got it in escrow for them. So I think that's a huge advantage to these builders.
Yeah, for sure. And the ability that it gives them to scale and scale quicker than it would for waiting for a property to sit on the market, right? There's ebbs and flows of every single market where properties can sit on the market for longer than expected from even when you started the build, maybe 6-12 months ago. Being able to capitalize on the opportunity to pull cash out before that property has actually sold and the exit strategy has been performed. That's a huge thing that we're seeing consistently in the market. Really just as soon as that property's got the certificate of occupancy, people are then capitalizing on the cash out. Number one, it gives them the cash out, but number two, it also gives them an additional 12 months to actually sell that property. So if you're in a down market at the time and properties are sitting on for longer, the bridge loan is the perfect loan type to actually get longer to sell that property when you may be in an up market for that specific spot.
Yeah, absolutely. And if you're a builder and you're watching or listening in, make sure to give Joe a call. He'll be happy to walk you through our bridge loan process.
That's right. Ring a ding ding, call the king.
All right, Joe, let's talk about some common considerations when investors are looking at a bridge loan, what they need to understand when trying to obtain one.
So first of all, I'd say a bridge loan's not like a Netflix subscription, right? You're not planning to be in the loan for years and years. It really is a short-term loan to bridge the gap between performing where you're at right now as the investor on any given project and performing the exit strategy. So one consideration to take into account is bridge loans are typically more expensive than the longer-term loans. When I say more expensive, really all I'm talking about is the interest rate.
Yeah.
The actual closing costs that are associated with it are very similar to a longer-term loan. So the only thing that is more expensive would be the interest rate. Again, you got to consider that, yes, it's more expensive in the rate. However, it's a shorter term interest only loan.
Yeah.
Your plan is not to be in it for multiple years. Your plan is to be in it for around 3 months. So again, the difference between a 6 to 8% interest and maybe a 9 to 11% interest rate, which the bridge loans would be. The difference is not going to hurt your project if you're using the bridge loan correctly and you're performing your exit strategy within a good time frame.
Yeah, I always like to use the saying with borrowers, it's not cheap money, but it's fast money.
Yeah.
I think it kind of sums up a bridge loan to the T. One thing that Joe already kind of touched on is these bridge loans are typically 6 to 12 month terms. They're not designed to be over a year long. And again, there's no prepayment penalty on these loans. So you'll see a lot of investors get a 12-month term bridge, but they refinance it within 2 to 3 months, or maybe they sell the property within 2 to 3 months, and then they just pay it off. And again, there's no prepayment penalty to that client for paying off early. What are some other considerations you think investors should look at whenever looking into a bridge loan?
For sure. So another consideration, which I believe to be the biggest consideration, not just because that's what we look at as a lender, however, the investor also needs to look at it as well, is the clear exit strategy.
Yep.
Since these bridge loans are not designed to create forced equity built in a property through the use of rehab funds, there is really nothing that is building equity in the property while in a bridge loan, so there's no benefit to using that other than it is bridging the gap between the two scenarios, right? So the clear exit strategy, you are trying to get in and out of that bridge loan really as quickly as you possibly can, because it's, like I said, it's not the be-all end-all loan that you're going to have that property sitting in. So whether it's going to be a refinance or a sale of the property, typically they're the two exit strategies that we see. You really want to pinpoint down to which one you are going to go for and start moving towards that goal, right? So whether it's a sale of the property, you want to have that property listed on the market.
Typically prior to getting the loan.
Typically prior to getting the loan. As a lender, we definitely want to see that if it is a sale exit, well, show us that you are really planning on trying to sell that property. So let's see that property on the market. So it can start actually getting traction. So you're actually moving towards your exit strategy.
Yeah.
And then whether it's a refinance rate, maybe into a longer term loan, let's start moving towards that secondary goal of refinancing the property and start getting quotes. You can even get quotes from ourselves and our team can start working on it. Or whether you may go to a different lender, right? There is options out there. I'd like to say that you want to keep everything in-house, but definitely as an investor, you want to be moving towards your exit strategy as quickly as possible once you get into a bridge loan, and your consideration prior to actually obtaining that bridge loan.
And I think one thing to note too is that the reason why these exits are so important is the maturity dates, right? Understanding that when you obtain these interest-only loans, you owe the full loan balance, right? That you're not paying down principal throughout the loan. So understanding that a maturity could come up in 6 months or 12 months, whatever term loan you get, you have to ensure that you're going to exit prior to that maturity date. So I think that's why the exit strategy is so important, especially in these short-term loans, especially in today's market. We know how slow properties are moving currently, especially in some markets that maybe have some downturn or maybe are declining markets currently. So very important. All right, Joe, let's go over some bridge loan tips for any of our viewers out there who maybe are potentially looking to get into one.
Yeah, absolutely. So I'm going to rehash it again. Know your exit strategy.
Yeah, I think another one is understanding that this is designed to move quick. It's not a crutch, so it's not the end-all be-all.
Yeah, and move quickly. Bridge loans are there to move quickly in situations that are going to bring opportunity.
I think another one is don't over leverage. I don't even know if we've mentioned that yet. At the end of the day, this is a loan that you have to pay off very quickly. So over leveraging yourself will put you in a situation that you don't want to end up being in.
Yeah, and then I would say don't tell your spouse that you got a bridge loan until you've told her the exit strategy.
Let's go ahead and kind of loop Park Place back in here. Let's talk a little bit about what Park Place bridge loan terms look like and what we have to offer to investors currently.
For sure, yeah. So as we said earlier in the episode, there's two types of bridge loans. There's a purchase bridge loan, and then there's a refinance bridge loan. It's both under the same umbrella, but it's just two forms of transactions that you can use the bridge loan for. So first of all, in terms of a purchase, what we do at Park Place Finance, we can finance up to 80% LTV, which means loan to value or loan to purchase price of the subject property. Now, the property does have to be in a stabilized condition, i.e. there is no rehab that is needed. A tenant could technically move into the property next day and actually start renting that property. But we go up to 80% loan to value, which is actually super competitive in the hard money space or even the private money space. So that really just means that the client would come in with 20% of that purchase price as their down payment into the deal. So really, typical bridge loans are at 75%, right? That's what we usually see. So the ability to put that less 5% than you usually would at any other typical lenders, I think is just a great tool for full-time investors to keep their funds in their pocket and not actually have to spread the funds thin across multiple different projects or just one project maybe.
Yeah, absolutely. I think that product specifically on the purchase side is huge. Like we see it a ton for maybe somebody who's buying a house that is rent ready, but they plan on tearing it down. You see it a lot in California and Florida, where it takes anywhere from 6 to 10 months to even get a permit and plans and all that put together. So they'll go and they'll put a tenant in the property for a little bit, get that 80% LTV loan while we wait and get the actual entitlements done on the property before refinancing into a construction loan. Let's touch on the refinance side of it. So for our rate and term product, Park Place Finance will go up to 75% of the appraised value, so long as you've at least had 6 months seasoning, right? So, and what that means is 6 months of seasoning is you've owned the property as the owner for at least 6 months. So your name's been on title for 6 months at a time. And at that point, we will go up to 75% of the appraised value. So that's very lucrative for maybe an investor who bought the property originally and did a fix and flip loan. Maybe they had it at 65 ARV when they originally closed. That now gives them roughly 10% equity that they can now tap into to pay off the original loan, maybe what's listed for sale as we originally discussed, pull out some equity, or maybe their loan is maturing, right? Maybe the project took a little bit longer than they wanted. They've got to refinance it while they work on permanent financing.
Absolutely. And when we're talking about seasoning or appraised value, right? We're talking about the new appraised value of the property. So we're not talking about your cost basis into the deal, which would be your purchase price. We're plus your construction, right? We're actually using the now appraised value of the property because there's been forced equity done through the form of rehab there. So that is key. And then can you just talk to us a little bit about what a rate and term means compared to a cash out means?
Yeah. So a rate and term and cash out, the difference is the amount of cash the borrower is going to get in hand, right? So rate and term typically means most of the time net zero to a borrower, if any cash at all. Sometimes they might even have to come out of pocket for that refinance. But really what that terms mean is 2% or less cash out. So if you get a $100,000 loan amount, that would mean you're not going to walk away with anything more than $2,000 in your pocket. Anything over $2,000 in your pocket, if you're looking at a $100,000 loan, which would be anything over 2%, would be considered a cash out loan. So that's what we're looking for, is that 2% rule.
Yeah. Really, you're just changing the rate, right? And then you're changing the term of your loan. So you may have been on a 6-month term, now you may be going to a 12-month term, whatever that may be. That's really the main difference there. And what would you really say the benefit is doing a bridge rate and term compared to a bridge cash out, and vice versa?
It really depends on your exit strategy, right? Let's say you have a ton of equity in there and you're not necessarily looking to pull cash out. You don't need to capture or seize that equity. You're just looking to actually get out of the loan before it matures, before your exit comes to fruition, whether it is a sale or refinancing the property, right? So if that's the case, then you would typically want to use a rate and term and not tap into that equity if you don't need it. Whereas if you need it, you would want to go the cash out route. So it really depends on your exit strategy, I think, is the true answer to that question. Then last one we want to touch on is Park Place's cash out. So we will go up to 70% LTV on a cash out refi for our bridge loans. I think that's very lucrative because that does allow you to tap into most of that equity. We see a lot of lenders out there offering anywhere from 65 to 70. So we are very competitive on that. And we love to look at those, especially for the builder program that we previously mentioned in this podcast.
Yeah, absolutely. And with the cash out for the builder program, right, you're pulling cash out of a newly built, you have your certificate of occupancy, the property is listed on the market. It's really, how I see it, is a circular wheel, right? So we help you finance the land and the construction. You then complete the project, you put it on the market, we pull your cash out at this point. We then help you obviously use that cash out for the down payment that may be needed for the land and construction. And then it's a ever-going circular wheel. And then as you gain traction, then you get another wheel, another wheel, another wheel, and that's how you really expand with a lender and utilize our flexible financing options to be able to expand and grow your business as a developer. That's it for the episode of the Loan Lads podcast this week. Until next time, keep your bridges short and your exits smooth.
Love that. Also, don't forget to like, subscribe, and share, and check out parkplacefinance.com for your bridge loan or other financing needs. Also, stay tuned. We've got some special guests that are going to attend some of these next episodes, so be in touch.